Hi, everyone. I want to thank you for taking the time to view this presentation, Investing in Turbulent Times. My name is Scott Tuxbury, Vice President of Retirement Plan Consulting for Sapers& Wallach. Sapers& Wallach has been around for over 80 years. We are a fiduciary for the retirement plans we consult with, which means that we are a flat fee organization. We are independent and conflict-free. The guidance and advice we provide our clients is independent and always puts their best interest first. We are an SEC-registered investment advisor through Lion Street Financial. If you're concerned about the economy and its potential impact on your retirement plan savings, you're not alone, which is why we feel it's pertinent at this time, during the pandemic of coronavirus, we provide an overall education around navigating market uncertainty. We will review recent events and how they might have affected your portfolio. Lessons learned from past downturns, and strategies to consider. We'll begin with an approach that can help you remain focused on your retirement strategy, taking the emotion out of investing. I'm sure you've heard this before, but it's the cornerstone of what we're going to be talking about today. It's natural for emotions to play a role in many of the decisions that we make. Investing is no exception. This graph shows the emotional highs and lows the average investor can experience over the course of a typical economic cycle, meaning good times and bad. Now consider how your emotions change when you're surrounded by negative stories, the headlines about how poorly the markets and the economies are doing. At this point, it's not uncommon for investors to begin to question whether they should be in markets and sell when market values are declining. However, these emotional-based decisions can cause setbacks in your retirement savings plan. Taking emotions out of the equation can help you remain focused on your long-term retirement strategy, and a helpful first step to get a better understanding of the nature of the market cycle. Let's take a look at the emotions of investing a different way, through the performance of the S&P 500, which is represented by the black line going back to 2002 all the way to 2014. We overlaid the emotions that we know people felt during this time period. The red bars represent actual outflows out of S&P 500 index mutual funds, where the green bars represent actual inflows, people adding money to the S&P 500 index. And if you look at the emotions that people felt, we know the overall adage to make money with investing is to buy low and sell high. But actually, when the market was doing poorly during the 2000 and 2009 financial crisis, people redeemed from those accounts. So the emotional decision to move to a safer haven or to actually remove your exposure to equities was real. We know through the aggregate of big data, we polled Americans during the decade of 2000 to 2010, and we asked them, did you behave rationally with your investments during that time period? 96% of Americans came back and said they did. But you can see through this chart, rather than buying low and selling high, people did the exact opposite. They sold low and bought high. The industry calls that the herd mentality. The herd mentality is, hey, what is everyone else doing? And hey, if everyone else is doing it, then maybe I should be doing it too. What do they know that I don't know? Well, what we know at Sapers & Wallach is, again, the way to make money with investing is to buy low and sell high, to push through these economic downturns. We've experienced them before, and we most certainly will experience them again. But if you have time, the ultimate equalizer to risk is time. And our view is if you have more than 7 years to go to needing access to this money for retirement or for a specific purpose, then our recommendation would be to forge ahead. Do not follow the herd. Next, let's take a look at the history of market cycles. By looking at market performance over a longer period of time, we can better see how the markets behaved during different good times and bad. Volatility is nothing new, and in fact has always been a part of economic cycles. So let's take a look at a little longer view. Let's go back 55 years to 1960 and carry this forward to 2018. The light blue line represents the performance of the S&P 500, which is a good indication of the overall strength of the US economy. As you can see, the dark tan lines represent periods of contraction, or when a bear market, a 20% decline in the overall stock market performance, was experienced, versus light tan when the market was actually expanding or growing. As you can see, going back 55 years, there have been many more times of expansion than actual contraction. Although it is important to note that there have been periods of times of, again, contraction or bear markets. As referenced previously, we know we're going to experience good times and bad, but what investors do with that information is one of the key drivers to their overall long-term retirement plan success. Which brings us to the question on everyone's mind: when will the markets recover? No one can predict precisely when markets might recover, but by taking a step back, we can see that historically markets have rebounded. Going back to the 2000 to 2002 bear market, the dot-com bubble or the tech wreck, we know we experienced a couple really major news stories. Y2K, the computer systems that were turning over from one century to the next. We had the tech wreck, the dot-com bubble, where the valuations of technology companies that had grown so rapidly during the late 1990s were beginning to decline. And we also, as a country, experienced 9/11. All these factors compounded the overall stock market poor performance and produced a bear market. But as you can see, it took 4.2 years to recover from peak to trough to peak again. The snapshot of the bear market, again, only lasted 2 years, but it took 4 years to recover. Let's take a look at another example, maybe one more in the more near term. The most recent bear market of 2008, the housing bubble. The downturn lasted around 2 years, but the overall recovery period was 3.1. Why was it shorter than the previous downturn? Well, if you remember, during that time period, or August of 2009, the US government decided to stimulate our economy, very similar to now. Last time they placed $685 billion of stimulus into our economy, as well as the federal government, which provides the interest rate that many banks use to loan money to individuals or corporations for auto, home, and credit card, lowered that rate to 0.25%. The Federal Reserve has done something similar, where they've actually lowered rates during the 2020 coronavirus crisis to 0. And additionally, they've placed $2.4 trillion of stimulus into our economy. They've extended unemployment benefits. They provided short-term loan for small businesses to make sure that they can meet payroll. And we think all those factors considered should be taken into a place when deciding whether or not equities or stocks are still the right strategy for you. Now that we have a better understanding of the history of market cycles, going back to 1960, the two recent downturns during 2000 to 2002 and 2008, it puts it into perspective. So let's talk about what you can do now to help position your account for future growth. Strategies for coping with market uncertainty. One of the most effective strategies over the long term is to stay invested. There is no crystal ball. Eliminate or realize the emotional roller coaster that you're experiencing at a time in which you're making an investment decision, and resist any temptation to sell at a loss. Let's use 2008 bear market as an example. At the market bottom, which is March 9th of 2009, an investor had two choices. And you can imagine at the actual bottom of 2009, that's when investors were feeling the most nervous. The first was to remain invested in the markets. The second was to sell their equity investments and purchase fixed-rate investments like bonds or bond mutual funds. Notice how if an investor sold their holdings at the market bottom, they would only be worth $49,089 5 years later. However, if the investor made fully committed to the markets through its ups and downs, i.e. taking the emotions out of investing, buying low and selling high, the investment could have grown to over $138,000. This again proves the emotions are real. When you make an emotional decision to sell out of a security, you also have to equally make the emotional decision to buy back in. It's twofold. So normally, as we've showed through the previous slides, that investors don't do that until the market has recovered, i.e. gone back up again. Again, what Sapers and Wallach is trying to provide for advice and guidance for individuals is that the ultimate equalizer to risk is time. If you have time on your side, this is a great period of time to forge ahead, resist the temptation to cash out, and continue on with your long-term retirement plan strategy. What a difference a few days can make. Despite what we have discussed so far, when faced with the markets that are moving up and down, some investors still choose to cash out and temporarily convert their holdings into a safer fixed income investment. The truth is, nobody can predict this. You have to be able to time the market correctly, not once, but twice. Take a look at how retirement plan saving balances could have grown if an investor changed their investments or more importantly, missed just the best 20 days of the overall stock market performance going back to 1998 through 2018. Think about that. In a 20-year period, if an investor just missed the best 20 days of stock market performance, check out what their rate of return would have been, what their realized rate of return would have been in the S&P 500. If from December 31st, 1998, an investor put $100 into the S&P 500 index, it would have gone up over 283%. If an investor was fearful during time periods when the market was going down and redeemed and missed just the best 20 days of upside performance, their return would have been negative 6.41%. That's really dramatic. So again, Savers and Wallach would deploy for all individuals that are fearful during this current market downturn. If you have time to forge ahead, even missing the best 20 days can have a dramatic results on your overall performance of your retirement plan account. Let's take a look at this previous chart set a different way, through the value of $100. If an investor put $100 into the S&P 500, the value at the end of 2018 would have been $383.75. Versus a different investor that missed the best 20 days during that 20-year overall stock market performance, that $100 would be worth $93.59. When it comes to overall retirement savings, not only do we have to ensure that we're, again, buying low and selling high, and taking advantage of market conditions when they happen to us, but also understand that inflation risk is real. Again, the ability to purchase more goods and services when you actually retire is the overall goal. People feel they need to get a 300, 200% return to actually make it. You really don't. You just got to stick with your overall long-term planning objectives, not try to time the market, take the emotions out of it, and forge ahead when the market experiences downturns, no matter what day it occurs. Another strategy often considered by emotional investors is to continue to keep their money invested in their existing retirement plans, but stop making their regular contributions. These investors don't realize that there are benefits to still making those contributions periodically through payroll deduction. To understand, let's take a look at this graph. The example shows that when market values drop from $50 to $25 to $20 and $10, you'll still be able to buy more shares at a lower price. Notice how the average cost evens out the highs and lows. This strategy is known as dollar cost averaging. It can really help investors buy more shares when markets are declining. We often talk to many record keepers during this time period and say to them, we know that investors, when they log into their account, they're going to look at how much their account value is worth, how big your pie chart is. But what we would like to also revert your attention to, and we'd like record keepers to highlight, is to how many shares you are accumulating during a downturn. Share accumulation is a key driver to your overall retirement plan success. So again, when the market is experiencing a downturn or a contraction, a bear market of 20% or more, get excited about the fact that you're actually purchasing more shares of the same mutual funds you would have purchased anyway if the market was doing well and you were feeling euphoric and excited about the fact that, again, the economy was continuing to expand. From an investment standpoint, you shouldn't mind when the market goes down, because you're buying funds on sale. In addition to making regular contributions, diversification is another effective strategy that can be used by participants. The reason diversification is so important is because each sector of the economy can perform differently at any given time of the market cycle. This chart shows you how a group of sectors, each represented by a unique color, you can see that there is no pattern really from year to year. A sector could do great in one year and be at the bottom of the chart the next year. Now notice how the navy blue boxes are in the middle of that chart every year. These blue boxes represent a diversified portfolio, which is invested across multiple asset categories, styles, and sector. The performance of the diversified portfolio was more consistent than the others in the example. There are no extreme highs or no extreme lows. A diversified portfolio aims to provide a steadier and more consistent return over a long period of time. We hope the presentation, Investing in Turbulent Times, will help you navigate uncertain markets. Understand the emotions you're feeling right now. Is this a good time to sell, or is this a good time to buy? The historical context of overall past market downturns. Has the U.S. economy experienced past downturns? Yes. Has the economy recovered from those downturns? Yes. Put it into perspective as it pertains to the time you have to weather the current market conditions. Although there is no prediction of future results, we do feel over the long term, the more time you have, the better you should feel about staying the course and forging ahead. And get excited about the fact you're able to purchase more shares through dollar cost averaging. Keep your portfolio diversified and understand your own overall risk tolerance as it pertains to your long-term retirement plan strategies. Lastly, the good news is you don't have to memorize any of this. Sapers and Wallach has been around for over 80 years. We are fiduciaries for the retirement plans that we advise on and give guidance to. If you have questions, please feel free to reach out to your retirement plan wealth counselors at Sapers and Wallach. We've implemented a virtual inbox where you can ask questions to get answers quickly. If you do have questions or concerns, please email solutions@sapers-wallach.com. Our team of wealth counselors and financial planners monitor the inbox and will be able to respond to your questions quickly. If you don't have access to email, you can call us at 617-225-2600. Thank you, and hopefully this presentation has been helpful. Have a great day and stay well.